Okay, well, I hope you enjoy Bruce Willis movies because they're not particularly realistic, but you just sit back and enjoy the fact that the bad guys get shot. Okay, well, that's sort of what's going to happen here, right? We're moving into a really, really tightly woven theoretical environment. And so you may think, well, that doesn't seem particularly realistic, but we are shooting lots of bad guys in the sense of we're getting rid of lots of unsystematic risk. So you just kind of have to kind of go with the flow here. You've probably been to a Bruce Willis movie and, with somebody who complained how unrealistic it was all the way through and ruined it for everybody. Well, don't be that guy. Right? Anyway, so let's think about capital market theory. So again, this is hardcore financial economics. At the end of the day, what we're going to see is some things that actually come out of this that do get used in the market. So assumptions of capital market theory. Wow, this is a big list, right? Investors use a mean variance framework. Okay, there's unlimited borrowing and lending at the risk-free rate. I don't know about you, I can lend at the risk-free rate pretty easily, but when I try to borrow at T-bill rates, people laugh at me. Homogeneous expectations. If you think the world has homogeneous expectations, well, then one night watch Fox News and one night watch MSNBC, and you're going to see that people do not have the same expectations. One period time horizons. So we all have a single period over which we are building our portfolios. And you can see the rest of the list down here. It goes on and on. I don't think memorizing this list is going to be way important on the exam, but the point to remember is that, yeah, we're going to get really strong results here. Okay, but to get those strong results, we had to make really strong assumptions. And here you go. And in fact, this isn't all of the assumptions. So this is what makes the world maybe seem a little bit unrealistic. Anyway, remember I said that there was these two very highly used formulas, Gordon growth model, which is elsewhere in our coverage of the material, and this thing, the CAPM, the capital asset pricing model. So this is probably the biggest or the most influential result to come out of financial economics in the last 50 or 60 years, something like that. And we are certain that it's incorrectly specified, although the idea behind it, the notion of diversification and systematic risk, has lots of legs, and it leads to a lot of things that we use in the market all the time. So we just need to be able to get through this. So what it says is the expected return on any asset is equal to the risk-free rate plus the beta times this thing, which is also called the market risk premium. Okay, well, if we have an estimate of the return on the market, we can get the risk-free rate out of the newspaper. Okay, and then if we were given the covariance of the asset in the market and the variance of the market, well, we just worked with this formula a couple of moments ago. So that's an estimate of beta. We could also get an empirical estimate of beta by looking at the return on the market minus and up here the return on the asset, and we got all the dots, right? We drew a straight line. The slope of this line is the way we would estimate beta. Of course, that beta, given the mathematics that we use to estimate the line, is the covariance of the asset in the market over the variance of the market. So these two things are the same. It just depends on sort of the mental framework you bring into it. But at the end of the day, you can think of this as a closed form solution for the required return on a security. Now, this reads expected return on the asset. It's an expectation of the return when the markets are in equilibrium. So yes, it's appropriate to label it as an expected return. But I think it's probably best to think of it as a required return. Required what? Well, it's required because the firm has this level of risk. So this is the market risk that's embedded in the firm. Some firms have more market risk than others, right? So if you think of, I use the example of a Harley Davidson. Well, when the market's up, well, everybody needs a $40,000 motorcycle, right? So the Harley Davidson's way up. And then when the market's down, well, then people think a Honda scooter just looks a lot more practical, right? So Harley would have a very high beta. Market's good, it's doing great. Market's down, it plummets. Okay, so it have a lot of it would follow the market in exaggerated fashion. It has lots of systematic risk. Okay, if you thought of a consumer goods provider, somebody that was making toilet paper, well, if the market's up, maybe sales are up a little bit. I'm not sure why. If market's down, they may go down. I'm not sure why again, because it doesn't matter what else happens. Well, we are still going to need toilet paper. So that would be something that would be a low beta firm. It has low systematic risk. So if you think the markets are going to go up next year, you need a diversified portfolio, but you can stuff it full of high beta securities. So you're buying luxury good providers and Apple and all the tech companies, and when the market's up 10%, your portfolio goes up 20%. Okay? And if you think the markets are going to crater next year, then you want low beta, conservative securities. And if you're confident enough in your prediction the markets are going down, you may even want to go to cash, which has a beta of 0, right? So this is the capital asset pricing model, and it's, in my mind, it's almost unthinkable that you would go through the exam at any of the 3 levels actually and not use the CAPM more than once, right? So this is something you certainly want to know what's going on. So the CAPM, it's an expected return model. That is, it's expected return given the systematic risk and when the markets are in equilibrium. Okay, but again, I think it's best to conceptualize it as a required return model. This is for the typical investor. They have an array of investment opportunities out there. Okay, they can build diversified portfolios. Okay, and there's actually an assumption that investors are having diversified portfolios here. We'll talk about whether or not that's appropriate in a little while. But nonetheless, they can get, given the beta, what return would they require to invest in this firm? Well, if they can't get at least that much, they're not going to invest because they can get that much from the average firm in the industry or in the market. So the required return and the expected return would be the same in equilibrium. But again, if you'll think of this as a required return model, and particularly it's a required return on equity, we're applying it to assets here, but when we do it elsewhere in the curriculum, we're likely to think of it as the required return on equity. Then I think that will help you or bolster your intuition. So this, the security market line, this is the graphical representation of the CML. So it's the risk-free rate plus beta times the market risk premium. So here's when the beta of the market's equal to 1. Well, here's the expected return on the market. If you have a beta that's higher than 1, then you would get your required return would be higher. And if you had a beta that's lower than 1, your required return would be lower. So if you think of this straight line, well, remember the formula for a straight line, y equals mx plus b. Okay, well, here we go. It's going to be the return on the asset, y is equal to mx, which we're going to have as beta I times the market risk premium, okay, plus b, which is going to be the risk-free rate. Well, I didn't write that very well, but anyway, that's supposed to say risk-free rate. All right, so this is just an equation for a straight line. So this is the SML, the security market line, and it compares the return on the security to the security's systematic risk. So beta is a measure of systematic risk. Standard deviation is a measure of total risk, right? So we've got to keep those two things straight. So total risk is measured by standard deviation. It's both systematic and unsystematic. But remember, our systematic risk principle says that what's important in terms of pricing securities, okay, is not total risk, because part of total risk, that is unsystematic risk, can be diversified away. What's important is the systematic risk. So this is a systematic risk model. Okay, when we have this one factor that determines return, it's the level of risk of the asset as determined by its level of systematic risk. Okay, so it's the relationship between systematic risk and expected return. It's the SML, and it's just the graphical representation of the CAPM, right? So this, you should, the CAPM and the SML, you should link those two things in your mind. All right, so CAPM and expected returns, the stock has a beta of 1.2. So is that an aggressive or a conservative asset? It's aggressive, right? So if the market's up 10, this is going to go up 12%. So it has a beta of 1.2. The expected return on the market is 8, and the risk-free rate is 2%. What's the stock's expected return? Okay, well, all right, what do we know? We know the risk-free rate's 2. We've got a return on the market. We've got the stock's beta. So all we're going to do is plug in. So here's the risk-free rate. So remember, this is just the risk-free rate plus the individual beta for the stock times RM minus RF, all right? Okay, so, and that's equal to 9.2%. Now, before we move on, I want to change this problem, okay? So how would this have been different, erasing this, if instead of saying the beta of the stock is 1.2, and then I'd said the market risk premium, okay, is going to be equal to 6%. How would this problem have changed? Okay, well, the answer is, okay, it would have been 2% plus 1.2 times 6%, which would have been equal to 9.2%. The point I'm trying to make is that they can give this data to you in two ways. They can give you RM is equal to 8% and RF is equal to 2%. And they can let you calculate the market risk premium. Okay, it's supposed to be an F down there. Or they could tell you the market risk premium, okay, is 6% and the risk-free rate is equal to 2%. And that's exactly the same thing. If they give you the market risk premium, they've already subtracted out the risk-free rate. So what they are tempting you to do is to say, here's 6% minus 2, and to subtract out the risk-free rate again. Okay, well, you don't subtract it out twice, you only subtract it out once. So they can give you the market risk premium, where they've already subtracted out the risk-free rate, or they can give you the return on the market and then let you subtract it out. But you've got to be careful about what's going on when you're reading the question. So this is the market risk premium. Again, that's RM minus RF. Whether they give it to you in two parts or one part, that's what you have to put in there. All right, so expected return or required return model, expected return in equilibrium on this asset would be 9.2%. Right, easy to use. If you don't know the capital asset pricing model by the time exam day rolls around, then my advice actually is to not waste a Saturday. So go spend it with somebody you love. You'll have more fun. So because this is certainly something that is so linked to so many other things that we do, you're going to want to know what's going on here. Now, how would we use this? Okay, so this is called an asset pricing model, and what we do is calculate required returns. Well, how do we use it to determine if assets are appropriately priced? Well, this would be a very typical exam scenario, maybe a little bit simple, but this is something, the logic here is very sound. So here's what we've got. We've got a risk-free rate in this environment of 7%. The expected return on the market is 15%. So the market risk premium is 8, right? They could have given a market risk premium of 8 and had exactly the same information on the slide. And we have three stocks. We've got the price today. We've got the price a year from today because we have a crystal ball or we have a price target. And we have the dividend that the stock pays. So, and we also have the individual betas for the stock. So if we take these betas and we combine them with this information, we can come up with a required return via the CAPM, right? And if we have this information, okay, so the 25, 27, and 1, well, then we can calculate a holding period return, right? So the holding period return, okay, is going to be equal to the price at the end of the period minus the price at the beginning of the period plus any dividend that we received during the period over the price at the beginning of the period. So this is the capital gain, this is the cash flow. So if we have 27 minus 25 plus 1 over 25, well, that's going to be equal to the return that we're going to earn this year. It's a holding period calculation, but they give us the data such that it's timed over a year. So whatever this turns out to be, okay, well, that's going to be the holding period return. That's also called the forecast return, right? So you have to make sure you understand that this is going to allow us to come up with a required return based on the asset systematic risk. These things, well, this is known, but this and this, those are forecasts. There's an individual analyst that has said, I think this is going to be 27 at the end of the year. So given the analyst's forecast, is this thing under or overpriced? So what we can do is calculate the forecast return, and we can compare it to the required return. And what do you want? Well, you want to buy assets that have a high return relative to what you require, and you want to sell assets that have a low return relative to what you would require, right? So let's see how this plays out. And so using the data here, so 25, 27, and 1, and then the data for all the others, we have a beta of 1.8 and 1.2. Okay, well, we can calculate for stock A the forecast return. So 27 minus 25, there's a $2 capital gain plus a $1 dividend. So we have 3 divided by 25. That gives us a 12% forecast return. So for this analyst, okay, this forecast return is also sometimes referred to as a private expectation. This analyst is expecting a 12% return on this stock. All right, well, that's great. Is that enough to compensate for the risk? Well, if we plug all this information into the capital asset pricing model, the required return, given the level of rates, that is the risk-free rate, given the market risk premium and the amount of systematic risk, what's required here to make me invest and maintain my investment in this asset is a 15% return. Let's see, this is what I would get based on market returns generally adjusted for risk. This is what this asset's offering. Okay, well, does that look like something you want to buy? I really need 15% to justify this. What this is going to pay me is 12%. No, it doesn't look like a very good deal, right? Okay, so that means that asset A is going to be overvalued, right? So what about asset B? Well, we use the data to calculate a forecast return of 7.5 versus a required return of 13.4. Hey, given the risk, I should earn 13.4 on this, but I think I can earn 17.5. That's the way you get rich, by buying those types of assets, right? So you earn returns that are higher than what's required. Okay, so this asset B must be underpriced. Get rid of some of this red mark. And then for asset C, well, it has a forecast return of 16.6. It has a required return of 16.6. Hey, that must be exactly correctly priced, right? So let's chart this relationship. So here is our SML, the risk-free return, the risk-free rate is 7%. Okay, we could plug in, we can find, the return on the market here. So if we had a beta of 1, well, we come over here and that's going to give us a return of 15% because that was the expected return on the market, right? So we could put that in if we wanted to, but we've got the SML here. We can go through and this SML is just the graphical representation of this. So here would be beta for asset A. Okay, it had a beta of 1, and this is what the return was, right? So let's see. So if we bought asset A, okay, we would have a required return up here, but what it's actually offering us is just this, right? So we needed a return up here, okay, but we're only getting a return down here. Well, that's whatever they're asking for that asset, it's too much. Right? So the return is too low to justify an investment here. Okay, so since this asset A plots below the line, okay, well, it's probably not something that we want to invest in, at least if we have confidence in our forecast. What about asset B? Well, it's a relatively low risk asset, and based on its risk, we should get returns here. Okay, we should get a return of 13.4%, but man, this asset's offering us a return way up here. It's 17 point something. Okay, well, this asset's offering more than the required return. That's the asset we want. Okay, so asset B is the one that plots above the line. Okay, that's the one that we're going to buy. And then asset C, of course, the required and expected were, or the forecast and the required were the same. So it plots exactly on the line. So if you buy it, you get exactly what you're being paid for. So you pay for exactly what you get, I guess the other way to say that. So what does this mean? Well, when we plot these things for the CAPM, we buy those things that plot above the line. Why? Because they're offering more return than what would be required, and we sell stuff that plots below the line. So we sell down here and we buy up here. Right? So these are undervalued assets, these are overvalued assets. Right? And you have to be a little bit careful with this because if we get rid of this, on the exam, they're going to give you, forecast returns and required returns, but they tend to give you assets like this. Something that plots here above the line and something that plots here below the line. Well, this one is the higher return asset, right? So it's, way up here, but it's got so much risk, it needs a return here. Make sense? So even though this is the lower return asset, this is the one that's undervalued. So this is the one you want to buy. This is the one you want to sell. And they're going to try to make it, well, why would I buy the lower return and sell the higher return? It's because there are differences in risk. So if we have this asset and this asset, remember, we buy above the line, we sell below the line. And if that's too low risk, then buy it on margin, lever it up. Okay. So that's how we use the CAPM to value securities. We find the forecast return, we compare it to the required return, and we buy those things that plot above the line. So here's a summation of this. Forecast versus required. Required's higher, so that asset is overvalued. Okay. Forecast for asset B, 13 versus 17 in forecast. Well, that's the asset that's undervalued. We want to buy this, okay, and we want to sell stock A. And stock C, well, that's just correctly valued. So if we buy it, we get exactly what the amount of return that we should get for the risk that we have. So this is just what happens if you buy all the assets in the market, right? You're going to be converging to the risk-adjusted return. All right, so that is forecast return and CAPM. Here is a comparison of the CML and the SML, and I think this is relatively important. Okay, so the capital, and so we've looked at both of these. Remember, this was the CML was the combination of the market-efficient frontier and this idea of array coming out of the the risk-free rate, so we found that point of tangency, so we ended up with this portfolio M, okay, and the risk-free rate here, and then we got all those linear combinations. Okay, this is a function of all those assumptions that we came up with and assumes perfect diversification. Let's think about differences between these two lines, all right? So first of all, okay, in theory, all assets plot on the SML, okay? All assets plot on the SML, period, okay? In equilibrium, all assets plot on the SML. So if you get something up here, well, that's the one that's undervalued. Everyone's going to want to buy it. As they buy it, they bid up the price, and it's going to drive it back down toward the line. Something down here, it's overvalued. Everyone's eventually going to recognize it. They're going to sell it. The price is going to go up, and it's going to push it towards the line. So in equilibrium, all assets plot on the SML. Notice that that's possible because the measure of risk is beta, or systematic risk. So all assets plot, and we end up with this because the measure of risk is systematic risk, and that's the risk that matters. If we're looking at the CML, okay, the measure of risk here is, should have been on here, is the standard deviation. That's total risk. So this sentence, CMA has only efficient portfolios. Okay, excuse me, the CML has only efficient portfolios on it. Okay, but there's a simpler way to say that. Okay, the only thing that plots on the CML are efficient portfolios. I agree, but there's only two assets that plot on the CML. Okay, it's the risk-free asset and it's this market portfolio M. Okay, so all these other things are inefficient. Okay, and we wouldn't want to buy those. So this is the difference between these two are the risk measures. Okay, this is total risk. This is just systematic risk. So the only thing that can plot on the CML are the efficient portfolios. That means those that are perfectly diversified, which means that there's just M and RF. Okay, and so we only get two assets that plot on the SML. This we can use to price securities, okay, just like we just did in this last example. And this is an asset allocation model. We can say, okay, well, we want to invest some of our money in the market and some of our money down here because we're looking for a total risk of something like this. So we decide whether we want to lend or borrow, buy on margin or lend at the risk-free rate, and we move up and down the CML. So this is a capital allocation tool. This is a security pricing tool, if you want to be extreme about it, right? So the SML versus the CML, okay, it's important that you be able to compare and contrast those. It is something that is near and dear to the hearts of the people that are responsible for the curriculum and the exam. All right? Okay, so what about applications of the CAPM? So we've gone through this world and we've watched a lot of bad guys get killed. In other words, reference to the Bruce Willis movies. Doesn't seem particularly realistic, okay? But in truth, this thing gets used all the time, okay? Yes, it's misspecified, all right? There's no question about that. I'd love to live in a world where the CAPM worked, okay? That's just not the world I happen to live in. But that doesn't mean that it doesn't get used in the market very frequently, all right? So where does this come from? Okay, well, so we're actually starting with capital market applications rather than the CAPM. Okay, but what we're going to see here is that when we look at the CML, so this is the market portfolio M. Okay, so and here is our CML right here. Right? Well, what is the slope of this line? Okay, well, slope is rise over run, right? So what is the rise here from this point to this point? Okay, well, the rise is going to be RM minus RF, right? So RM minus RF, and the run is going to go from 0 to the standard deviation of the market. So that's just going to be standard deviation of the market minus 0 or the standard deviation of the market. The point is that this thing, the return on any asset, I'm going to put P for a portfolio, minus the risk-free rate. Okay, we've talked about that before. That's called the excess return, divided by the standard deviation of the asset. Okay, that is called the Sharpe ratio. Okay, so we've seen that elsewhere in the curriculum, but this is a tool that is very frequently used for evaluating portfolio managers. And the trouble is, if you look at two portfolio managers and you see that you get this, so we're looking at total risk against return here, and we get this portfolio manager and we get this portfolio manager. Okay, well, which one of those is better? Okay, which one would you choose? Well, if you're just looking at those two dots, you'd have to have an argument about your risk preferences, right? So I would choose this one if I had low risk tolerance, and this one if I was more risk tolerant. Okay, but we don't have to do that because we have this risk-free rate, right? So if we have the risk-free rate down here, well, we can create 1 cal here, and we can create 1 cal here. Okay. Well, now we know which one's better, right? The higher the cal, okay, the better off we are. Would you rather invest here or here, right? It has the same risk, but if you buy the higher variability portfolio and then lever it down a little bit, right? Take on some T-bills, okay, well, then you get the same return, okay? You get the same risk, but you get higher return. So everybody is going to choose to invest with the higher cal. And the point is that the slope of a cal is the Sharpe ratio. The Sharpe ratio is equal to the return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. So this is the Sharpe ratio. It's how we evaluate the efficiency of a portfolio. It is the excess return per unit of risk. And the point that we're making here, okay, is we can think about the market return. And we can calculate the slope of the CML, okay, is this. That's the Sharpe ratio of the market. Okay, if you want to prove to me that you are beating the market, okay, well, then you show me that you have a higher Sharpe ratio. So we're using the Sharpe ratio for this portfolio. We're comparing it to the market. If you think you're a superior portfolio manager, fine. This is how you show me. All right. So you calculate the Sharpe ratio of your portfolio. Sharpe ratio of your portfolio is going to be the return on your portfolio minus the risk-free rate divided by the standard deviation of your portfolio. And then I'm going to go out and I'm going to look at my portfolio, right? And I'm going to call mine M. Well, I'm going to get the return on my portfolio M minus the risk-free rate divided by the standard deviation of M. Well, if this one comes out to be 0.6 and this comes out to be 0.4, that means your return per unit of risk, okay? You get 0.6% per unit of risk. I'm only getting 0.4% per unit of risk. You win. All right, so we very frequently use Sharpe ratios to evaluate portfolio managers. And we're looking at excess return per unit of risk, and all this starts from the CML. So the Sharpe ratio is named after Bill Sharpe, who was the original, the prime, or at least given most of the credit for developing the capital asset pricing model. So the CML and the Sharpe ratio. This is absolutely something you want to know. All right. Okay. So what about, are there any other ways to do this? Right. Well, there are other ways to do it. Okay. We could also calculate something called the M square. And the point here is that, look, we've got these two portfolios. Okay. They have different, they've got different returns, but they also have different risk. Well, what we could do is we could say, let's compare them both to the market portfolio. And we could compare them to the market portfolio by calculating Sharpe ratios. That would be easy enough. Okay, but the problem is then you got to explain to your clients the Sharpe ratio, right? And not everybody understands it. So what we could do is we could calculate this M square. And if you have a higher Sharpe ratio, you're going to have a positive M square, and you're going to get the same results from your analysis. But what we're doing here is with the M square is we're saying, okay, I'm going to get rid of some. So this is what we think is the market portfolio. It's the S&P 500. Here's your portfolio. Okay, how can we make a direct comparison between these two? Well, because risk and return is different, we could have used Sharpe ratios. All right, but let's think about it. Let's just get return differences. All right. Well, we can't take return minus return because of the risk differences. But what we could do is we could run your portfolio up to here, okay, where it had exactly the same risk as the market portfolio. So if the risk is the same, then all we have to do is look at the difference in return. So the difference between the return on this portfolio 2 after we move it, adjust its risk to be the same as the return on the market, this distance, okay, that's called the M square. All right. So, and I could erase some of this. So this distance, so we took this portfolio, we levered it up to get it up to here. Okay, and then we said, well, what's the return difference if we isolate risk? So we have the same risk in both of them. Okay, well, now we have this one measure that we can use. So it's going to be the return on the portfolio minus the risk-free rate. We're grossing it up for the differences in risk, and then we're subtracting off the excess return on the market. So M square, I think this is something that you definitely would want to put on a formula sheet. All right. Okay, and the trainer measure here. So remember, the Sharpe ratio was, the return on the portfolio minus the return on the risk-free asset divided by the standard deviation of returns on the portfolio. So that was the Sharpe ratio. Well, okay, so the trainer measure is very similar. It's the return on the portfolio minus the risk-free rate, but in the denominator we have systematic risk. So what's the difference between the two? Well, the notion is, and I don't think this comes into play all that much in the real world, okay, but I have a friend that that manages an equity portfolio and has a boutique shop where, it's not particularly big, but it's enough that he makes a living doing it. Makes a pretty nice living, actually. But his whole thing is that he only has like 10 names in his portfolio, right? So 10 or 12, something like that. But he knows those firms better than anybody else. He can tell you he can tell you anything you want to know about executive compensation schemes at each of the firms. And, anyway, the point is, with 10 stocks, he is not well diversified. Okay, so there are times when you are working with investors who are not well diversified. That is, they still have idiosyncratic risk in their portfolio. Well, if you're dealing with an investor that is intentionally poorly diversified, okay, like an entrepreneur is poorly diversified, doesn't mean they're bad people, just means they don't have a whole host of assets. So then, using this idea of the return on the portfolio minus the risk-free rate over total risk, okay, probably makes sense. This is the Sharpe ratio. Okay, but if you have an investor who is well diversified, or who could be or should be, well, then you could use the trainer measure and just look at it as excess return per unit of beta, all right, instead of per unit of total risk. So the difference between the trainer and the Sharpe ratio, the Sharpe ratio can be used for poorly diversified investors, or at least investors who are intentionally poorly diversified. The trainer measure should only be used for those that are well diversified, or at least should be well diversified. Okay, so the difference between the two, and of course, if you get well diversified investors, okay, well then you're going to get the same, thumbs up, thumbs down result from either of these. Okay, but the difference that they're talking about here is when should you use one versus the other, and it's going to be whether or not you want to think of it as a function of total risk. Okay, that is unsystematic and systematic. Or are you just looking at it as a function of systematic risk? So the trainer measure just uses systematic risk and is only appropriate for a very well diversified investor. Okay, and then finally there's Jensen's alpha. So this is the return on the portfolio minus this. You'll recognize this as the capital asset pricing model, RF plus beta times market risk premium. But this is not the beta of the market. This is the beta of the portfolio. All right, so this is the return on the portfolio minus the risk-adjusted, what would be the required return on the portfolio adjusted for risk. Okay, so we're going to use the beta of the portfolio in the capital asset pricing model to get what its return should be. So if the return on the portfolio is equal to 10%, right, and then we plug in the portfolio's beta into the capital asset pricing model, and we get the expected return on the portfolio. The required return, expected return in equilibrium, is 11%. Okay, well, in this case, the alpha for this manager is going to be 10 minus 11 is equal to minus 1, right? So all we're doing here, instead of just taking the return on the portfolio minus the return on the benchmark or the market, okay, so instead of just doing a simple comparison without adjusting for risk, here we're adjusting the required return for the level of risk that the portfolio manager takes into the portfolio. So again, this is Jensen's alpha. Okay, alpha is this risk-adjusted measure where we take the return minus the risk-adjusted required return, and that is part 2 of this of the portfolio risk and return stuff. So we've come a long way from talking about what is a return and a means and all that sort of stuff, all the way through portfolio theory and into capital market theory and comparing the CML and the SML. I just can't tell you how testable this information is, given its importance elsewhere in the curriculum. Even if it weren't going to be tested, it would be something you would need to learn because it just has fingers all over the place. It touches so many other topics. So I think if you don't feel comfortable with this, spending some extra time on it now is probably time well spent in terms of getting ready for the exam. Good luck with this topic area.